Earlier, I'm Mark Trice, founder and lead advisor at Clear Vista Financial. I'm joined today by a fellow financial professional, Jesse Hamilton.
Good morning.
And Jesse is one of our professionals here in our office. We're located in Central Texas with several offices around in Austin, Waco, Temple, Brownwood, and maybe a few other places if we decide to add those later on. So we're glad that you've chosen to join us. We're going to really get started. I've mentioned about if you have a question, you can put that in the question box there. We've turned off the chat, so you can't do that, but you can put questions in there. So get those to us, and we'll try to get to those by the end of the program today. Let's go over our brief agenda, Jesse. Why don't you go ahead and jump and kick things off?
Sure. So we're going to look at the month of July. That's what we do on these webinars. We look at the previous month's performance for each of the major indexes. And then we're going to transition and talk about the economy, what's going on. We're going to talk about jobs, employment. We're going to talk about, are we in a recession or not? And we're also going to mention gas prices and what's going on with commodities and stuff. And then after that, like Mark said, we will address all your questions. So go ahead and put those in the question box and send them to us. But let's kick it off here with the S&P 500, which is the index that most people like to follow to see the large cap stocks. These are the 500 biggest companies in the United States. And I want to point out that for the first time this year, we didn't have a new bottom to show. So we changed peak to trough performance to year to date performance. So
yeah, because this was kind of a actually not a bad month.
No, it wasn't.
For performance and stuff like that. But yeah, we did not. June was the last month where we had to plot and show a new low. So this was some positive news.
Mm-hmm. This index was positive 9.11% during the month of July. This picture that's shown here is the candle chart of the trading days throughout the month. And you can see that they had some pretty good growth. 13.33 is the drawdown since the close on December 31st of last year. So we're still minus 13% year to date for this index.
And we had a little bit of a pullback in the middle of the month, but July finished strong. So Jesse, tell them what the candles mean, the colors and stuff like that.
So a green candle is a good day and a red candle is a bad day. That just means that the price opens on a green candle at the top or at the bottom and closes at the top, which means there was buying pressure and people came in and encouraged the price to go up, versus a red candle, it opened higher and closed lower.
So what about the NASDAQ?
So the NASDAQ was plus 12.35 during the month of July, which is a very strong figure. But year to date, that index is still minus 20.8, which is still considered to be in the bear market territory. And I guess we could talk about the fact that generally a bear market is not over until we see a return to the point where it started. Is that right, Mark?
That's right. So there's lots of definitions of a bear market. Generally, that's a minus 20% decline from the peak of that previous market cycle. And although we've come up about maybe 7% off that 20% mark, we're still in a bear market. Still in a bear market. Jesse, what are some of the companies that are in the NASDAQ? This is really kind of tech heavy, isn't it?
Yes, these are the large mega cap companies, a lot of the tech companies that we use every day, the social media companies, the FANG stocks, right?
Yeah, so that's the Facebook, Amazon, Netflix, Google, and a few others. Now small caps are really important because that if you're having a broad-based market increase, small caps need to be really doing well. And so how'd they do in July?
So our next index is the Russell 2000, and that performance was plus 10.56. And year to date, we're talking about minus 15.82%.
So not as strong as the NASDAQ in the month of July, but year to date, that hadn't suffered near as much as the tech companies had. So
Mhm.
that's something to be positive about. What about treasuries?
So the long-term Treasury index was plus 2.23. As you can see, this chart is not quite as strong as the others. Granted, it's a different type of investment, but still, you can see several drawdowns on the red candles, as well as a growth of only 2.2% throughout the whole month. And this index is minus 20.82 still year to date, which is pretty dramatic.
So, and bonds are supposed to be the safe place. Help people understand, Jesse, the relationship between rising interest rates and the value of the bond.
So market interest rates and the value of the bond are opposite. And some people would call it, the seesaw effect, right, Mark?
Yeah.
So
Oh, you got your seesaw example there on
double
camera for
seesaw
people that
right
are
here, yeah.
watching there.
Yeah, one side of the seesaw is the price of the bond, and one side is the interest rate, and they move in opposite directions.
So as interest rates have been rising, that's really putting a lot of downward pressure on the price or the value of those bonds this year. So
Correct,
we've
yeah.
seen dramatic increases in interest rates. Now, we had a little bit of a pullback in July, but it's been really volatile. I think the market's trying to figure out which way is the Fed going to act. And this month in July, a lot of us were sitting around scratching our heads a little bit, trying to figure out why is this market going up when the Federal Reserve is forecasting that interest rates are going to continue to rise for some time.
Hmm.
Yeah. Um, so Jesse, go. This is just a year-to-date performance of the S&P, right? The S&P
Yes, so
500.
I wanted to show this because it shows the bear market territory that we've been in for the past several months this year, and it shows the drawdowns and the returns, the rallies, and then another drawdown and then a rally. And you can see the month of June, there were several difficult days where we actually had gaps down and dropped down to a new low in the middle of June. But I drew this line here at 41.77 because that's a crucial level of resistance for the S&P 500.
Yeah, and I don't know if this chart just goes through the month of July. Is it showing this stuff from this week as well? The
Sorry?
first week of August. I think that's just through that's just through the end of July.
Yeah,
So
this is the end of
if you're
July.
curious, it's we're recording this on August the 6th, and it still has not broken through that line. That's some serious resistance.
Hmm.
And the reason that we talk about that is because of this next slide. The market bounce, you don't want to let that affect you. Jesse, why don't you talk about this a little bit with these bear market rallies?
Sure. So these two charts here show the S&P 500 during the 2000 2002 bear market and then the 2008 bear market. And as you can see, in 2002, we had 6 bear market rallies, and some of those were pretty significant. We're talking about over 20% type of rallies, and it will go to a new high and then come back down. Well, not a new high, but it will rally to a peak and then draw down even further. And then in 2008, we had 5 of these. So there's no way for us to know if that's going to happen again. We think it's highly possible, but there's just no crystal ball to tell us when that's going to happen.
Yeah, so looking at this, going back to the previous chart, you can see, and I wish I had my little highlighter thing. I don't want to mess up the little highlighter thing. Um, so we had a question asking the market is volatile. Yes, it is. It is this year for sure. We can see some of those rallies this year. Let me see if I can get my little spotlight thing over here, Jesse. Um, 1 second. Yeah, there's the spotlight thing. Where's it? Oh, it's showing up over here. Okay, sorry about that. Let me move my camera out of the way so I can draw on the screen. Well, so you see those little rallies here that we had in February.
Hmm.
We're going to have it trail off again. Had a really strong rally in March. This is where Kramer on CNBC screams at the top of his head that the bear market's over. But
Mhm.
oops, Kramer, it was not. We had another one. Then we had another rally in June, the first part of June, and you see it really hit this plateau here, almost around the price that we're talking about, the 41.77 on the S&P 500. And then it sold off very quickly in June. And we've had a strong run up since then, but we still have not been able to break through that level of resistance.
Right.
And so it's important to note that with this on the screen here. So what Jesse's talking about here is of great significance, that there's oftentimes rallies within bear markets. And so this run up of 9% or so in the S&P 500, that's great. We try to participate that when we can, but there's still an extreme amount of market risk out there.
Hmm.
So just be patient, folks, because there's a lot more to go. Whether or not it continues on up or it rolls over again, we don't know. But Jesse, I think we'll move now to the economic update.
Great. So we're going to shift gears here and talk about the economy and some more current events and what's going on in our country and in the world. So the big question right now is, are we in a recession? And
Yeah, and
so
depending on who you talk to,
yeah, we've had a little bit of entertainment over the past 2 weeks where um, traditionally the technical definition of a recession is 2 quarters of declining GDP growth. And so the White House produced this blog post a few days before the data came out and changed the definition.
yeah, and the definition has been changed because obviously the optics behind being in a recession are not good, and there's actually a fair amount of debate
Yes.
amongst economists, and there are folks on both sides of this argument saying that no, we're not in a recession, and one of the reasons that we're not in a recession is because we've got strong employment.
Hmm.
Because typically in a recession, Jesse, I think we talked about this earlier this week. Yeah, you mentioned the textbook definition is 2 consecutive quarters in a row of negative GDP growth or shrinkage in the economy. Well, and that is, and we've got data sources would go back where every president in the past has said we're in a recession. But
Hmm.
this White House doesn't want to do it. Actually, also they don't want to talk about inflation. So they'd
Right.
already started trying to put out the spin cycle, if you will, even before the Fed released its data. So this is going back historically, and it's interesting because every one of these periods, the purple down bars are contraction in the economy. And in every one of these, it was called immediately as soon as we got the second quarter of data. It was called immediately by the White House to say, okay, we're in a recession. And then you notice that every time there's two in a row, it's a recession.
Hmm.
And sometimes they last a little bit longer. But going over here to 2020, you can see that big long one. That was the pandemic. I don't call that a true recession because we artificially did it. We shut everything down.
Hmm.
And we've never had anything like that in the past where everything was just shut down. But you can see we quickly recovered. Well, we're in another recession now, even though the government doesn't say that. They want to say it's much more complicated than that. Anything you want to add to this, Jesse?
Well, you can just see the small bars here that go to 2022. And in comparison, you can see what we're talking about here. It does meet the technical definition, but you can see why it's up for debate, why people don't want to admit why we're in a recession right now.
And right now it's mild,
It's,
right?
yeah.
I mean, we had great employment report, and I'll get into that a little bit later. But here's past recessions going back to really the 1800s. This is probably
Mhm.
too much data to digest on a screen somewhere, especially if you're watching on your phone. The recession back in 2020 lasted only 2 months, very short. If you go back to something more recent, December of 2007, you had that lasted about 18 months. Okay, The recession back in early 2000s only lasted about 8 or 9 months. So that's the interesting. That we don't know how long this one will last. It seems to be very mild right now. We've got a number of other factors that are impacting us, which we'll get into in just a few moments.
Yes.
So this is something we were watching in June because at the end of April or the beginning of May, end of April, the Federal Reserve out of Atlanta was beginning their forecast and for the GDP, and they started out with we're going to have growth of around 2% annualized in the second quarter. And that's great. That sounds good. No recession here. Everything's hunky-dory. Inflation's not rising. We're okay. And as you can see from this chart on the kind of the green or the yellow line, I'm not sure what color it looks like on your screen, but the green line, they every week they update their estimates.
Mm-hmm.
And you can see as we kind of went along through the month of June, it was like, oh, okay, maybe not as much growth. And then finally it was no growth at all. And the week before the GDP stuff ended for the quarter, they were saying, hey, we're going to be negative or minus 2% growth in the second quarter. Well, they're already doing that now. Of course, it ended up second quarter was minus 0.9%, which is not too terribly bad, except that it's negative. And this was on top of the minus 1.6% from the first quarter. So we're seeing that as a concern. And yes, we do fit the textbook definition of a recession, albeit very mild at this point. So here's what the Federal Atlanta Fed is doing now. They started this at the end of July, and we started above 2% growth in the third quarter. I think 2% growth is just their baseline, Jesse. What do you
It
think
seems
that's
like
what they start with?
it does seem like it.
Yeah, it does. And so they've already started revising that. They're still positive right now, but this comes out every week, and we kind of know, by the time we get to the end of September, we'll kind of have a good picture of where the Atlanta Federal Reserve thinks the economy is growing or not growing. Okay, and so this is real important. I hope that there's positive economic growth. There's a lot of people that believe that we'll have positive economic growth. So it could be a short-lived recession, but we have seen instances in the past, especially during post-war years and things, where we have some decline, we have a little bit of growth, so the next quarter, so we're not in recession, and then we have decline after that. So it's not that cut and dry. The National Bureau of Economic Research is the non-government entity that actually puts this data out, and they've said, hey, there's lots of things to consider here. And what we found is that you're in a recession, and by the time that they report that it's a recession, the recession may be over. So hopefully that will be the case here with us in the United States. But because we had some good employment reports this year, and this is one thing. This happened yesterday, Jesse, where the U.S. Bureau of Labor Statistics released that the economy added 528,000 jobs in July. That what was the expectation? I can't remember. Was it?
It was 250,000.
250,000. So it almost more than double of what the expectation was. Now they had lowered the expectation from previous months. In June, the economy added about 378,000 jobs. So this is still an increase in that. Unemployment rate fell to 3.5. Now, this next bullet point is really interesting. Jesse, the labor force participation rate has been falling all year. Now, this is the percentage of eligible working age people to actually be in the workforce, and it fell from 63.4 to 62.1% in the month of July. Now, that's real telling.
So this is the one that maybe says people are not interested in working, even though they're eligible to.
Right. And so, in fact, there were actually there were 5 million unemployed people in July, but there are 3 million that are not counted. 3 million Americans that aren't counted because they've made the decision not to be in the workforce. Now, this is kind of a weird a weird statistic or indicator, Jesse, because once you reach the age of 65, you're not counted in the labor force participation figures. Now, why they've chosen 65, I guess that's just the magic number. Everybody signs up for Medicare or whatever. But folks that are 65 and over are actually not part of the labor force, which we know tons of people that are working beyond 65.
Yeah.
So, but the key here is there's a lot of U.S. Citizens that are not in the workforce, and that's increasing. So that's telling us that some folks are just saying, I don't want to do this anymore. And we're seeing layoffs increase as well. What was some of the big tech companies that announced layoffs this week? Was it
I think Google was up
Snapchat
there.
did something like that? Some
Well,
of those
sorry,
companies.
Google didn't increase layoffs. They just reduced hiring. A lot of the mega cap, huge companies decided to reduce hiring, and then some smaller tech companies are doing actual layoffs.
Yeah, doing actual layoffs. I think it was, I can't remember which company it was that announced they're going to lay off 20, 23, 25% of their workforce in Northern California. So the thing we have to realize here is that employment is really a lagging economic indicator. We can't drive down the street these days and not see a help wanted sign.
Mm-hmm.
And in fact, as Jesse and I were analyzing these things, we saw that the largest growth, the largest number of jobs added were in the service sector.
Yeah.
And so these are like hospitality, these are fast food joints, restaurants, things like that. And so what we're seeing is a lag of open positions being filled. And I think in next week when ADP and other folks release their data of positions that are open, we'll see those positions fall as well.
Mm-hmm.
So why this is a really positive note, the markets reacted negatively. Why do you think that was, Jesse? Do you think that, why did the markets react negatively to such a strong jobs report?
Well, first of all, people are not behaving rationally, but it's actually not as great of news as we think, right?
Yeah, and that's primarily because if employment was falling and the unemployment rate was rising, that would signal to the Fed that, okay, we don't have to keep raising interest rates.
Mm-hmm.
But a overly strong jobs report tells the data to the Fed, because they talked about this in their last press conference, tells the Fed that, oh, the economy is still hot. We've got to cool it down. And the only tool we have to do that is to continue to raise interest rates.
Mm-hmm.
So employment in this case, while normally we would see this as a good thing, the markets are going to see this as a bad thing. Okay.
Right.
So that's why we had a little bit of decline on Friday in the markets, but we'll have to watch this again and watch the unemployment figures and jobless claims and things of that nature if they continue to trend in direction, because that's the main thing, Jesse, we're looking at. It's not the number, it's the trend. And
Mm-hmm.
when the trend is rising, that's good in a normal situation, bad if you're the Federal Reserve trying to cool down inflation, which we'll get to now. So inflation numbers for July are supposed to come out on next Wednesday, July 10th, or August 10th, excuse me, August 10th. And in June, annualized year-over-year inflation was 9.1%. Now, they focus on this 9.1% number, the year-over-year number, because it's a little bit easier to understand. But the interesting things was in the monthly increases. So we saw in April, May, and June, we saw the rate of change actually accelerate. And so that's troubling.
Yes, it is.
The month over month increase from May to June was 1.3%. Folks, if that continues at that pace and you extrapolate that over the year, next summer we're not going to be talking about 9.1% inflation. We'll be talking about 17.1% inflation. Now, I don't have a crystal ball. Jesse doesn't have a crystal ball. We don't make predictions. I suspect that inflation will level off. We'll still have a high rate of inflation, but it'll begin to level off. And we're going to give you some data here in a minute for why we think that is. But the growth rate of inflation is actually accelerating. And that is concerning. And that leads us to believe that we think the Federal Reserve will continue to raise interest rates throughout the year. The markets are betting on that they'll change course in early 2023 and start lowering interest rates. But I think it's a little bit too far of a goal to believe that that might happen in 2023. Jesse, I can't remember what's the Federal Reserve balance sheet now. Is it still north of $10 trillion?
Yes, it is. Well, they've been reducing it, but yes, it still is.
And that's creating some of the volatility in the bond market because they're beginning to sell those bonds that they purchased over the pandemic. Some of them they're just letting them expire. They're not re-upping interest rates because, of course, interest rates are real high, and so that's creating some volatility there. But let's talk about reducing inflation. We talked about some tools the Federal Reserve has by increasing rates, but what is Congress trying to do?
Well, there's this new Inflation Reduction Act, which in many ways doesn't really have anything to do with inflation, but
what?
well, there's $739 billion dedicated to climate issues. I read an article about how high earners are going to have a much higher chance of getting audited because the IRS is going to dig in and find places where people can pay more taxes and collect more from the high earners in the country.
And that's a big part of the bill is to beef up IRS personnel.
Right.
And so our listeners probably don't realize this, but in 2020, 52% of the audits that were done by the IRS, now this could be a letter audit where they send you asking for more information, or it could be they drag you down to the IRS office so that you can sit before the IRS examiner. But 52% of all audits in the past have been on households making less than $25,000. Can you believe that?
Wow, that's a lot of resources.
That's a lot of resources for a little bit of tax money. And my belief, and a lot of pundits and folks that have been examining the legislation, and the Senate's kind of reached an agreement. They've done all their wheeling and dealing. The Senate's reached an agreement that should be going to be voted on this week. But yeah, over half of all audits are on households making less than $25,000. I know they say they're going to go after those that make a ton of money, but the reality is it's going to impact the middle class more than anybody. And also in the bill, Jesse, is the deficit reduction thing, which is kind of an accounting gimmick. If you want to reduce the deficit, folks, you just don't spend any more money. And this $739 billion for climate issues, which are really vaguely defined, is spending more money. And in fact, I was listening on the way in to do this program today. I was listening on the radio, and they reported one of my old professors at George Mason, Vernon Smith, was saying that this was going to actually increase inflation. This will actually accelerate inflation, spending this additional money, which is why we have inflation in the first place. We spent over $11 trillion pumping into the economy. When the government spends a lot more money, not only is it inefficient, but it actually pumps more currency into the system, more money supply. And this is why we've had this really high inflation. This is one of the reasons we've had it. And so we're proposing that we put more money into the economy.
Right.
And the fact that this little bill is called the Inflation Reduction Act is a joke. It will actually increase inflation. I was trying to think of some examples earlier, Jesse, of things where we have the name of a fund, and where you look at the fund and it doesn't have anything to do with the title of the fund. And
Yeah.
this is one of those gimmicks that Congress wants you to think that we're going to reduce inflation, and it's going to have no impact on inflation, except there is a high probability that it actually may increase inflation.
Hmm.
This is crazy.
Well, it
And
seems like the country and large corporations really have a lot in common in terms of their management style. They're going to make it look good no matter what they want to accomplish.
oh yeah, we've just come out of earnings seasons, Jesse, and we've been for all the public companies, and oh, the spin doctors are there. And I used to work in public accounting many, many years ago, and the accountants have to report the data correctly. But management of the company can choose to focus on the things that they want to focus on that make things seem much better.
Hmm.
So we have to watch out for this, folks. Pay attention, because what you hear coming out of the White House, what you hear coming out of Congress, um, is really not truthful, and it's misleading at a minimum. And there was an old joke when I lived in Washington D.C. that the joke went like this: Jesse is like, "How do you know when a politician is lying?" And the punchline is just when their mouth is moving. And so pay attention to what's going on. Another thing that's going on up there is that President Biden, who would not take the blame for rising gas prices, try to blame everybody else but his policies, now is taking credit for the price of gasoline going down. I think the average price this weekend was around $4.10 across the U.S. If you're here in Texas, it's quite a bit less. But what we've been seeing, the reason that the price has been declining, Jesse, is what?
The demand is declining as well. People don't want
Yes,
as much gas because they can't afford it.
we're using less gasoline, and so it's a basic. If you remember from your high school economics class, supply and demand. When the demand drops, the price will fall. And so this is what the Federal Reserve is trying to do. This is what the government's trying to do. They're trying to crush demand. They do not want you spending your money. But the reason that gasoline prices have been dropping is because we've been using less of it. And you may be able to relate, right, Jesse? I mean, have you planned any long cross country road trips?
No.
Uh, no,
And
and
also,
we
the
we've
way
had folks
I'm
tell us,
seeing it is my friends and I tend to carpool when we go a distance greater than a few miles. We're going to ride together,
yeah.
save gas.
So, and we know of folks that have modified or canceled their vacation plans because it's just too costly to pull a trailer or drive a car across country or different things like that. So this is from Yardeni Research. This is showing through the end of July, and you see that little hook down. The big V there on the chart is actually looking at the pandemic recession, but
Hmm.
this is really a big drop there for July. We are actually consuming less. The red line on this one here is another negative sign that we're consuming less gasoline. So even though the White House wants to take credit for these things of fighting inflation through the Inflation Reduction Act, and also having some impact on gas prices that have nothing to do with actually fighting inflation, and they have nothing to do with actually lowering the price of gasoline. It is anything that's policy related is having a negligible, if any, effect on gas prices. So a little bit of news here. This is, we may have heard last month we talked about, hey, the first 6 months of the year were actually the worst start in the stock market since 1970, and so that was concerning. But we've been putting this up here, and you can kind of see like the average returns of the stock market, the S&P 500 historically, and you've got some positive history there. Now,
Hmm.
you can also have the bad history that's down the bottom line there. where you continue to have declines. We have no way of predicting what is actually going to happen in the stock market. We know that it will continue to be volatile. We know that there's a lot of data, economic data that'll be coming out in the coming months. I noticed that England last week, Jesse, announced that they're in a recession. Apparently, 2 quarters of negative economic decline or a recession in other
Yeah.
parts of the world, just not here in the U.S. So there's going to be a lot of things happening. And yes, we still have geopolitical conflict. I mean, China today is doing military exercises in near Taiwan, and who knows what will happen there. A lot of uncertainty, but we shouldn't be worried about these things. We should just know that our clients know that what we're doing is we're simply looking at the data, responding to the data. We're not trying to guess about where the market's going. If you haven't had a chance to visit with one of our financial advisors, you really should. I will take questions if you put them in the question box if you want them. And you can always contact us anytime and schedule an appointment with us. We do most of our initial consultations via phone or a virtual meeting, and then we can make a determination. We'll talk to you. We'll see if we can help you in any way. You get a chance to ask your questions. Those consultations are complimentary, and hope that each of you that are listening will take advantage of that. You can just give us a call at 800-491-4508 or visit us on the web. I know it says clearvistafinancial.com up here, but you can also, most people can remember spendlifewell.com. That goes to the same place. Jesse, can you think of anything else we need to add here to
Well,
this program today?
we had one question come in. It says, what do you think about alternative investments such as commercial real estate when the market's volatile?
Yeah, okay. So, there are different asset classes that are doing better this year than others. And energy has been the dominant one this year. I noticed looking at some of our indicators, utilities is actually positive for the year, but real estate's been kind of struggling. Now, if you're looking for a long-term investment, then maybe that might be suitable for you, but we really need to talk to you further about whether or not that is appropriate for your portfolio. When we see the real estate sector doing well, we're going to own some of that in our client portfolios. But when it's not, we want to stay away from that. And Jesse, you probably got more insight on this, but we've been kind of struggling whether or not we should be adding real estate to our portfolios lately because of a couple of things, really. Rising interest rates,
Right.
and the continued forecast that that's going to continue for a while. That has a damper on real estate, and then just the securities themselves are still struggling to see if they can find direction. That chart we showed you on the S&P with that resistance level at 41.77 is really critical, and I think a lot of things will open up and we'll see more breadth to the rally if it breaks through that. If it doesn't, we may kind of move sideways for a while, or we may roll over again and set a new low in the markets. Jesse, you have anything to add to that?
No, I think that's a great response. Like Mark said, when it's working, it's great, but that doesn't mean that it's more or less volatile than other sectors of the economy and the stock market. Looking at it in a short term versus a long term hold are going to affect your decision as well. But generally, yes, there's still a lot of uncertainty on the table. Remember back to the employment numbers, we talked about that group that is choosing not to work right now. That might continue to happen. And so in terms of commercial real estate, we just don't know what's going to happen in the future.
Yeah, it's just too early to tell, folks. And we don't believe in trying to time the markets. We think that's a bad approach. We'd like to see momentum return to real estate and see that that's going to be a what's a good word? A better long-term view on that. A lot of people will hold real estate and have a more longer-term view of that. We're saying this is a really volatile market. We should be careful about what we're putting money into. I know a lot of we have a number of folks that are buying physical properties, and you're starting to see in the markets that you're in, you're starting to see that the average days on market are rising, meaning things are not selling as fast. And with rising interest rates, you're also seeing affordability drop as well, and that's a concern. So we want to see interest rates stabilize because that is there is a fairly strong correlation between interest rates and real estate, and we want to see those things improve before we're saying that we want to jump back into real estate. Jesse, is there anything else on the question board?
No, I think that's all.
Great.
Feel free to send us your questions though at that info@clearvistafinancial.com, or give us a call during the week. We'd love to talk to you about maybe you have a different opinion about the economy. We'd love to hear from you.
Yeah, and send us a question, because sometimes we'll put those on our radio program,
Hmm.
which we do every Saturday morning, 8 o'clock on 1120 a.m. The Bridge, which is broadcast out of Austin. Most of Central Texas can pick that up, 1120, or you can just pick up their app, thebridgeaustin.com, and we are on the radio 8 a.m. every Saturday morning. And we want to thank you. From Jesse and I, we want to say thanks for attending today. If you have questions, please contact us. And if you'd like to schedule an appointment, please contact us. The month of August it's fairly busy for us, so let's get in the queue, and we hopefully can visit with you here real soon. But thanks so much for joining today and listening in. If you register today, you'll get a recording of this webinar here in probably about 10 days. But have a wonderful Saturday, and thanks for joining us.